Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I've got a familiar face on the podcast this week, Mr. Bushy Martin. Bushy, welcome. It's great to have you back on.
Always, mate. Love talking all things property with you, Pete. So looking forward to some fun again today.
Yes. Now, we covered in a previous podcast episode how yourself and Sonia have built a life for yourself where you've been able to travel. You can do your business flexibly, and that has come about through strategic investment in mainly residential property. And I believe you've been traveling a little bit over the past week or two. Where have you been and what have you seen?
We've felt a little bit like caged chickens the last couple of years as a result of COVID, Pete. So the opportunity to get out and about now, we've just been itching to do it for ages. And I guess aligning our own lifestyle needs with the opportunity from the property side of the coin. There's a lot happening and a lot has happened in property around the country. And the exodus to lifestyle in particular is something we really want to get a feel for on the ground. So we use the excuse to head down to Tassie. Tassie's been top of the pops for quite a period of time now. If you look at, the escalation in property values, even in Hobart in particular, over that time. So we felt it was time we actually got on the ground and got a really good sense. We focused this time. We started in Launceston and headed west. So we've done the northwestern sector of Tassie, and there's some great little pockets there. So Hobart and Tassie in particular have seen fairly sharp rises, particularly over the last couple of years and a bit longer. But there's still some really good opportunities in those sort of lifestyle locations along the coast. And I guess the quadrilla of rail, road, boat and air, there's a number of locations along that coast that tick all those boxes. So the likes of Burnie, the likes of Devonport, there's some really good locations there where there's really strong infrastructure, really good opportunities, still coming off a very low cost base, great places to live. And they also happen to be in the marginal seat areas that the federal election is focusing on. So they're going to get flooded with government money in the next couple of years. So there's some really good opportunity in that neck of the woods.
Yeah, it's interesting, isn't it? We were chatting just before we came on air, and about 10 or 11 years ago, my wife and I did the big lap of Australia. It took us over a year to get around, but it's only really when you get out and travel the country, you get a real feel for a lot of the sort of regional cities or country towns, what they're actually like. And there's a whole heap of places that we went to that I'd never been to before, like Port Augusta or Queanbeyan or Mandurah, all around the country. And even now, a decade on, I haven't necessarily been back to a lot of those regional cities, but at least in my head, I can visualize what they're like. And you do get a feel for some of the demographic trends. So do you think, I've been traveling around the last couple of weeks, it does seem to me that even though a lot of people are still working from home or working remotely, I've certainly noticed Sydney and Melbourne around the CBD, something got a whole lot busier. Do you think there's been any kind of reversal of that sort of return to the capital cities, or we've got people keeping a foot in both camps? What do you think?
I think there's a foot in both camps, Pete. I think what's happened over the last couple of years, people haven't been able to travel very far at all. They haven't been able to spend their money on much either. So there's big savings being ponded. We've got historically low interest rates. So people have been buying second properties, whether it be tree change, sea change. Some are relocating. I think what we're seeing in the CBD now is more a return to the sort of normal business activity, but after hours, it's still pretty quiet in my own experience. So I think there definitely has been a shift, and there's this talk about the boomerang effect. Maybe it was only temporary. I'm not so sure. I think the cities have got a lot of work to do, and it'll take a long time for that to resurface, because the golden handcuffs of putting money into property, it's not a cheap investment, and it's not an easy one to reverse either. So I think the sort of regional play and that exodus to lifestyle is here to stay with us for quite some time, particularly in those areas where the technology support and the ability to work permanently from home is easy. If the technology support's not there, then those areas will suffer, I believe. But as we know, with a federal election we're coming into, there's going to be a lot of money spent by both of the major parties in that neck of the woods. So I think it's actually going to maintain that sort of much more regional spread than we've seen for a long time.
Yes, my wife Heather was saying, I was in Sydney this week, but she was saying she took the kids out for a burger on a Monday night this week, and she said there was literally, this is in Noosa, there were queues down the street. It's absolutely pumping with people. Now it is coming up to Easter, but I've been saying for months now, I've never seen Noosa anything like as busy as this. Now, I presented at an event at the Gold Coast a week or two ago, and I saw Simon Kustenmacher from the demographics group, and he made some really good points about the changing sort of model of living. And his view was that we're moving towards what he calls a fried egg model in the cities, where people will still live within the gravitational pull of the capital cities, particularly professionals. They might need to be able to get to the big capitals, but they're not necessarily as closely tied to the CBD as they once were. And that seems to make a lot of sense to me, particularly, I think, in some of the areas that offer a good lifestyle, like the Central Coast or Sunshine Coast, South Coast of New South Wales, places like that. And I'm sure, you've seen plenty of it on your travels. I think the other thing that really stands out is just the sheer number of people who are getting out there and traveling and spending. The airport's a total mayhem at the moment. I think partly because a lot of people are off sick with COVID, but there's clearly a lot of money sloshing around in the economy because, as you said, people haven't been able to spend it for a while.
It's spot on. I think it's a very exciting time in property. As you and I both know, we've been in property for a long time, and we've seen the ebbs and flows of that over time. But I think what I'm loving about the impact of COVID, it's really leveled the playing field, particularly for regional hubs that have a critical mass where it can sustain a level of employment diversity. Those are the areas that are really benefiting from that lifestyle shift, but also as a property investor, some great opportunities that are emerging out of that.
Yeah, absolutely. Now, I guess the flip side to that is that with unemployment falling to 4%, record high employment, and household savings at the highest level they've ever been, there's $500 billion sitting around in cash and deposits. I guess there's no longer any need for the emergency settings on interest rates. And that's one of the things I wanted to tap your brains on today. I think if we were having this conversation last year, we were talking about the big surge in people fixing their mortgage rates on the assumption that rates would eventually rise. That has proven to be the case. Fixed rates are rising now. So what has changed to date in terms of the lending landscape? Obviously, fixed mortgage rates are on the rise, but what are you seeing in terms of the latest trends?
Yeah, well, across the broking side of our business, it's really interesting the area that we're in, because as you and I both know, Pete, property's always been a game of finance. It's the access to and the ease of getting credit that really determines what's happening in the property sphere. And the interesting thing that we're seeing at the moment is, firstly, that lending volumes have actually been decreasing. So we've seen about a 25% drop in lending volumes since December last year. So that's a reasonably significant drop. But even though the RBA cash rate has remained the same, as we all know, banks have their own discretion to set what's happening with fixed and variable rates. So while there's been a lot of scaremongering in the media about rate rises around the fixed component, and fixed rates have always been set at the discretion of the banks. They were extremely low because the banks could access extremely cheap money that was on offer until the middle of last year through the government sources. So there's no great surprise that they used fixed rates then as what I call bait and switch loans. So a bit like I like to refer to them as shagulator loans, Pete. So you get in on a cheap fixed rate, but when it reverts to the variable rate, it can jump up quite substantially. But because it's so hard and people don't have the time and it's too much of a hassle to then move, they end up picking up those customers much longer term. So what we have been seeing, as you already picked up, is we've seen fixed rates on the rise, and there's been an increase of between 1 and 1.5% since about the middle of last year in fixed rates. So that's a fairly substantial increase. But the other interesting thing is that variable rates are actually reducing. Since June of 2019, we've seen a drop of about 0.25% over the last year or so. So that's a fairly significant drop when there's no pressure to do so. And this is all about engaging opportunity. So I think what we're seeing in fixed rates, the banks are all pricing in potential rate increases. And it's got to be said that if you're, as an individual borrower, trying to beat the banks, you won't. It's never going to happen. They've got teams of people that are looking at what's going on there. So I think that with the growing differential between fixed and variable rates, we're seeing a big kick up in asking about fixed rates, but that race has already been run. If you wanted to fix your rates, you should have done it 12 months ago. There's, with a 1.5% differential on average between the fixed and variable, and that's widening as we speak, almost on a daily basis at the moment. There's 6 or 7 rate rises that need to occur before you're going to be back in front. So I'd be very cautious about jumping into fixed rate loans at the moment if cost is your major driver.
Yeah, it's an interesting point. I famously fixed a couple of my mortgages before the global financial crisis when mortgage rates were very high, but actually heading higher at the time that I fixed them. But I think over the life of the 5 years that I fixed, I was well behind by the time those fixed rates expired. And I think it underscores your point. I think a lot of people play that game of trying to fix mortgage rates to beat the bank, so to speak. I think it can work sometimes as a risk management tool, but if you think you're going to get ahead by second guessing the market, it usually doesn't work out the best way. There's a nice juxtaposition there. I would refer to those loans as bait and switch, as you said, probably a more refined background than your country upbringing. You go with a shagulator moniker, which is probably a more direct way of putting it. I think at the time of recording, the labour force figures were out today. The unemployment rate just a notch under 4%, but didn't really move a lot. So I think what that will probably do is it will give the Reserve Bank a bit of breathing space to sit pat through the election campaign. But I think it's fairly well accepted that come June, the cash rate will start to rise, probably by 40 basis points, which takes us up to 0.5%. So in the short term, you can have a pretty good stab at what's going to happen. My view is that the cash rate going from 0 to 1 isn't going to make a whole lot of difference because 1 is still a low cash rate. And as previously mentioned, a lot of people have been getting ahead on their mortgage repayments. But do you have a view as to what might happen to mortgage rates over the next couple of years and what the related impacts might be on borrowers?
Yeah, sure. So I think the jury's still out on when the rate rise will occur. I think the media is doing the work for the Reserve Bank at the moment just by signalling that there's potential rate increases. That is already having an impact on behaviour. And we're seeing it in the sort of questions that borrowers are asking us when they rock up to buy a property. So, and I think there's the big question mark. And if you focus very carefully on what the Reserve Bank governor has repeatedly said over the last couple of years and said again on the 5th of April, there's still a question mark around the supply side issues and in relation to how transitory or temporary they actually are. And I think the biggest question mark at the moment still is the wage side of the equation. So we're seeing inflation kick up, but is that going to continue? Probably not. Just because prices rise doesn't mean that inflation continues to rise. So it means that prices are going to continue to increase substantially for that inflation to happen. Probably unlikely, given what's happening in that space. Yes, the unemployment rate is going to stick around the 4 or below over the next couple of years. So that's a comfort level from the RBA. But the wage increase side is the big unknown. And I think that the RBA is likely to sit tight for a while. There's no rush. They keep saying that we can be patient, and they can be patient before that occurs. There's certainly mounting pressure for a rate rise, and the next move will definitely be up. There's no question about it. It could happen as early as the middle of the year. It may be September through to November before that occurs. And then I think what will happen is that they'll be just monitoring on an ongoing basis what impact that's having, because they don't want to pour water too much on the economy too early, because it could easily tip it back into recessionary modes, depending on what's happening on the wages front in particular. So I think we're likely to see, maybe 1 to 1% increase over the next 2 years or thereabouts. But won't be, I don't believe it's going to be rapid rises because of the impact that the media speculation has on that. I think the RBA is going to continue to be very cautious and very careful in the relation to the way they roll those rate increases out.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
I mean, a lot can change quite quickly, as you know, with this stuff. And it's actually remarkable to think it was only early October last year. So we're only talking 6 months ago. And Bill Evans from Westpac was saying we need to change the inflation target to 1 to 3% because we just can't get inflation high enough, sustainably above 2%. And yet here we are in the middle of April and people are saying we've got, potentially runaway inflation pressures. Now, it's interesting, though, the US this month saw headline inflation at 8.5%. The UK is at 7%. But Australia, for various reasons, hasn't had quite the same inflationary pressures. Energy prices haven't been nearly as drastically impacted in Australia. Goods inflation hasn't been quite as high. And as you mentioned, wages growth, although it's picked up, it is still pretty low. So I think the interesting thing is with the oil price coming down and petrol coming down, that actually those countries that I mentioned have probably already seen the peak of the cycle for inflation. I think the annual rate of inflation will start to come down. I think the thing that's giving people a bit of cause for excitement in the media is that other countries are hiking rates. New Zealand's up to 1.5 now with a 50 basis points rise. But even in Asia, countries like South Korea, we've got the Fed is talking about 50 basis points increases in the States. So, there's, I guess, a general feeling that interest rates should be going up. But I think, as you said, the Reserve Bank has said over and over again it wants to be patient. So it could well be a gradual increase. I guess outside what's happening with financial markets and expectations, what about on the regulatory side? Previously, APRA has been quite heavily involved over the past 5 years or so in terms of changing some of the lending standards, notably interest-only lending about 5 years ago. Then they made some changes to the buffer. So new mortgages are assessed with a 300 basis points buffer today. I guess one of the things that's getting some coverage is there's quite a lot of loans that are taken out at above 6 times income. Do you think there's any potential changes on the horizon to lending standards above and beyond what happens to mortgage rates?
Yeah, we're not seeing a lot So there's a lot of talk about it in the industry in the latter part of last year, and a much higher reliance by most of the banks on the debt-to-income ratios. So as you've already mentioned, and a lot of the banks now won't entertain anything over a six times debt-to-income ratio exercise. There's still some banks that'll go up to sort of 8 or thereabouts. No major changes in relation to the treatment of investor or interest-only loans. The thing that's been interesting to us in recent times, because there was a lot of scrutiny of living expenses in the latter part of last year, it was almost anal in the way the banks were diving into the detail, right down to spends on Uber Eats and the rest of the carry-on. That seemed to have eased a fair bit in recent times. So that pressure doesn't appear to be there. And that may be in conjunction with the improvements in open banking, where the banks now are able to share access to repayment histories to get a better sense of what the actual spends are without having to go through the interrogation that was occurring prior. So that's actually eased up a little bit. And a couple of other improvements that we're seeing as well, Pete. We're seeing that that self-employeds have always had a really tough time trying to borrow money, because if you're self-employed and you've got a good accountant, you try and reduce what your declared taxable income is to reduce your tax. But when you go to borrow money, that becomes a very tough thing. And there's a heavy reliance on the last 2 years' financials to make that happen. What we have seen, there's quite a change in the major banks. If you are a self-employed and you pay yourself a regular wage, so you've got pay slips that are attached to that, rather than interrogate the last 2 years' financials, they will take your own pay slips as an indicator of serviceability. Now, that's quite a shift in what's happening, and that's going to make it a lot easier for self-employed borrowers to actually secure money, particularly for property. So I think we're actually seeing, if I was to talk about the spectrum between restriction and loosening, I think we're actually shifting a little bit into the loosening phase. And I think the reason for that is that the borrowing volumes are down, and they know that the interest rates, that there are going to be interest rate rises. So that's coming. So I think that's going to self-regulate it a little bit from that context, and they don't need to put extra screws in terms of a borrowing policy to keep a hold of that.
Yes, I mean, it went way too far the other way, didn't it? I mean, I'd never seen anything like it before, when banks and lenders were checking, as you said, $10 line items in people's bank statements. It was very forensic. But then there was the ASIC court case, and the famous Wagyu and Shiraz court case. And I think, well, hopefully things have eased up in that regard, in terms of, it doesn't make any sense to be checking people's daily or weekly expenditure to the nth degree when you're taking out a 25-year mortgage. It doesn't make any logical sense at all. I think an interesting trend at the moment, and it goes back to the stimulus, I think, to some degree, but also because Australia has a very strong population pyramid, a lot of people coming into that household formation age. We've also seen a lot of people wanting more space and second homes, as you mentioned. And I think as well, with employment now hitting the highest level in history, we've got a lot of people who are quite keen to get out there and rent property. Now, you've been down in Tasmania this past week or two. I can tell you in Noosa, there is nothing for rent. In fact, it's become sort of crisis territory up here, and it's got to the point where rents have gone so high that actually we've got some properties sitting empty that nobody wants to pay the $1,000 a week they have to pay for a half decent townhouse or property these days. Did you get any feel for that on your travels? Because obviously Tasmania has been one of those places where there's just been no stock for rent, real stock shortage. I saw in Adelaide the vacancy rate 0.2, which is the lowest, I think, for any capital city in Australian history. So did you get a sense for rental demand when you're out and about?
Yeah, exactly. Reinforcing what you've just said. Everywhere we look, there's a rental squeeze. And it might be a combination of the fact that during the heat of COVID, there were landlords that were put under pressure. But I think if you combine that with the fact that people buying second properties that aren't necessarily renting out for investment purposes, together with the big rush back into Airbnb properties because there's an impression that they're going to get bigger incomes from them, all of a sudden we've got a massive shortage of stock right across the board. And that's not going to go away anytime soon. In fact, I think it's going to get worse, unfortunately, Pete, because with the international borders starting to open up, we all know that migrants generally rent at least for the first couple of years while they get their feet on the ground. That's going to put some massive increasing pressure on both the availability of rental properties, but also the rents that people are going to pay. So I think the government's been basically pointing the finger at the private sector as far as the supply side of property goes now for decades. I think it was back in the 70s and 80s was the last time that the government's got serious about looking at the supply of housing across the board and leaving it to the private sector, given the uncertainty that's there. They're not likely to be able to pick that up given, if we start to build property today, it's 1 or 2 years before it hits the ground and a lot can change over that period. I think we've got some real challenges moving ahead for rentals right across the board, not only in Tasmania, but just about everywhere you look, Pete.
Oh, yeah. I mean, the national vacancy rate has halved from a year ago from 2% to 1%. And in some parts of the country, I mean, it's really, really chronic. And we've effectively taxed foreign investors out of the market, and that used to be one of the key sources of new building. And new apartments were largely funded by non-resident investors. That's gone. Super funds don't really do property as much as they used to. So it's very hard to see if net overseas migration goes back up to a couple of 100,000 per annum, plus you've got the natural growth of the population. I just can't. Maybe I'm missing something. I just can't see where everyone's going to live. I think this is maybe one of the points that gets missed when people say, well, mortgage rates are going to go up. But yeah, they are, but so are rents and so are incomes. So I don't know that some of the mortgage stress modelling you see out there doesn't necessarily factor in the reality too much. Have you noticed a sort of a sentiment shift in your recent client communication? I think investors will be looking at some of those cheaper markets where rents could be rising at 20% per annum. Presumably, there might be some interest there. But do you think sentiment has cooled with all the media talk about potential rate hikes?
No, I think the big sentiment changes that we're seeing, there's much more talk around fixed rates. On the finance side of the equation, we're still seeing a very solid stream of investors coming through and seeing good opportunities. The opportunities tend to be in those regional hubs that we've been talking about, which, if we looked at it 2 or 3 years ago, most people were getting as close to the CBDs of the major capitals as they possibly could. There's been a significant shift in both an awareness and a preparedness to actually start investing beyond that. So I think that's a pleasing thing in terms of it increases the opportunity base pretty substantially. And we're also seeing I think one of the major benefits, if I can put it that way, of COVID is because we've become so technologically reliant and things like Zoom, like we're talking on today, have become almost standard fare. We're seeing people that are much happier to be borderless in their approach to the investing exercise. So, prior to COVID, if you couldn't drive past it and touch it, then there was a fear factor associated with it. With the improvement in the communications, but also the amount of data and the desktop data that you can access, help you to make decisions on, it's significantly opened up the area of opportunity. But what's missing there, I think, is the boots on the ground exercise. So, there's a lot of buyers agents operating out there that are focusing purely on desktop data. That's okay as a first pass, but you really need to get down and dirty on the ground to talk to local property managers and players in the space to get a real sense of what's not going to come through on the desktop. And that is areas locally that people like and dislike. Something can look really good on paper, Pete. It can tick all the boxes from a numbers perspective, But if an area has a ingrained perception that's not supported by the locals, and it has a demographic and attracts a certain type of demographic that's not going to be good for investment, then that's the piece that gets missed. And that's the reason why we're actually, jumping on planes and cars to actually travel to these locations to get a real sense of what is it like on the ground. But I think in summary there, the positive opportunity is that people are much more prepared now to look further afield than their own backyards. And with all of the information that goes with that, and then linking in with a national network of specialists on the ground, there's a great opportunity for investors moving forward, which we're seeing a lot of starting to take advantage of.
Yes, there's an interesting cautionary note from the States, wasn't there, with Zillow and people using desktop data for property flipping, essentially. And there's some quite high-profile reports there of people coming unstuck because they weren't inspecting the properties they were buying, and algorithms and desktop figures can only take you so far. And I guess real estate is a local asset class. There's local nuances or property-specific conditions that you don't necessarily get a feel for when you're just looking at figures and data. And I think sometimes, you really need, if you're not going to visit the property yourself, you need some local expertise and a trusted advisor to step you through that. So I guess to wrap up today, Bushy, it looks like mortgage rates will go up. As you said, the timing is somewhat uncertain, but mortgage rates will rise at some point. I think some of the more interest rate sensitive sectors of the market, particularly where people are heavily geared, might feel the impact of that more than others.
Great.
But incomes will go up, and particularly rents, I think, in some of those, particularly some of those sort of regional or lifestyle markets, are going to see some very strong growth. And in fact, if you look further afield, financial markets are saying by 2024 in America, interest rates might be dropping again by then. So I think, people needn't be too spooked by the cash rate going up a little bit. If anything, it's to be expected. But do you have any sort of tips or insights for people looking to invest today? How should they prepare for the prospect of rising interest rates? Any certain sort of property types or markets they should be looking at, or any insights or tips you can give?
Yeah, well, given the sort of the finance focus of the discussion today, I think I've always believed, Pete, that you need to plan for the worst and then expect the best. So rates are going to increase, no question about it. Does that mean you jump into fixing your rates? No. But what it does mean is that you need to make sure that you are stacking the odds in your favour by making sure you've got really strong buffers. So one of the, let's talk specifically about investors here for a second. A couple of the things that I think a lot of investors miss out on is the opportunity to focus really critically on the strategy and the structure of their finance to de-risk their portfolios. So one of the things I always recommend is to make sure you've got a standalone structure. So each property has a separate loan and potentially a separate lender, so that one lender doesn't have control over it if something goes wrong. So that's the first exercise, and make sure you focus on the capacity of your lending as an investor. Don't focus just on the rate, because it's tax deductible debt in any case. So you need to make sure that you're doing that. The other couple of things going to make a massive difference to your cash flow. One, make sure you've got a tax depreciation schedule on the properties, and a good quantity surveyor, if there's not decent value in doing the schedule, they'll tell you and won't cost you a cent, but you can get some appreciable benefits from doing that. But also in conjunction with that, particularly if you're an employee or a salaried employee, have a close look at doing a PAYG tax withholding variation. So that rather than wait to the end of the year to get your lump of money back in your tax return from having the investment property, you get that incrementally with every pay, which means you've got more money in your pocket more often. And if you're using it well, pushing into an offset account against your owner-occupied home, you're going to pay it off far quicker. The second thing I would do is, rather than fix the rates, I would make your repayments at the equivalent fixed rate, but keep your loan variable. So you've still got full access to the benefits of the offset account. You're going to be ponding money in that source, which will increase the buffer. But at the same time, you're effectively paying down the debt faster and saving yourself thousands in interest as a consequence. So they're only small things, but they can make a big difference in terms of bulletproofing and reducing the risk factor and improving the cash flow in an environment where we'd like to see rates go up in the short to medium term. Yeah,
that's fantastic. It's a few years under the bridge since I've been a salaried employee, but I used to love those PAYG variations because, as you said, it's better to get the dollars back in your pocket rather than leaving them with the ATOs. I'm sure Kerry Packer had a quote about how well the tax office uses your money. So fabulous insights as always, Bushy. Any more travelling on the horizon for you guys?
Yes, well, as I mentioned briefly off air, we're really planning a big road trip starting in the middle of the year for 6 to 9 months, and we're going to be travelling the East Coast and potentially across to WA and doing some more of Tassie to really get an on-the-ground sense of what's happening in those areas, given our belief that the exodus to lifestyle is going to continue to maintain really good property opportunities in those regional hubs.
Yeah, I think the affordable price access points and the prospect of rising rents will keep people very interested in residential property as an investment asset class over the next couple of years, rate rises notwithstanding. So, Bushy, thanks so much for coming on. It's always great to get your special insights, and look forward to catching up with you in due course. And maybe we should do a Bushy roadshow as you travel around the country.
Well, I'll be up for that.
On the road.
love to share the insights on particular locations if that's helping your investors to make better decisions, mate.
Live from Port Augusta, you heard it here first. So, Bushy, thank you so much, and speak to you again soon. Cheers.
Thanks, Pete.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.